Let's start in North Africa, where opponents of President Mohamed Morsi have called for mass protests on Friday and Sunday to demand that he steps down after 1 year in office. According to economists, growth is slow, inflation is high, and public finances, quite frankly, are deteriorating. A new round of bloody and prolonged protests would only therefore add pressure on a currency which trades on the black market and an economy fighting for survival. With the details, here's CCTV's Yasser Hakim.
The latest spate of violence ahead of demonstrations called for by the rebel movement is adding more damage to a country trying to overcome economic challenges, such as a devaluating currency, a growing budget deficit, high debt figures, and foreign currency reserves that can barely cover 3 months of basic needs.
The government has gone a long way to attract foreign investments and tourism, and there were signs of improvement in both. The two represent 60% of Egypt's hard currency that is needed to fund imports of food and energy.
There is an ongoing energy shortage visible in the long lines in front of petrol stations and the daily electricity cutouts. Analysts see the continuous protests as the main cause of this crisis.
There
were 250 demonstrations in the last 2 years. How can the economy function under such circumstances? If protests turn violent and prolonged, we expect production to slow down. We will lose tourism, foreign investments, and more devaluation of the currency.
The central bank and the government have been working hard to control expenditure and the value of the pound by limiting dollar withdrawals and restricting imports to only basic necessities. Meanwhile, efforts to secure a $4.8 billion IMF loan have been hampered due to the government's fear of applying the required austerity measures in an already boiling atmosphere. In spite of the glim outlook, analysts say Egypt has the proper infrastructure and expertise to bounce back from this crisis. The magic word, they say, is political reconciliation. If this is achieved, the economy will boom. This is Yasser Hakim for CCTV, Cairo.
Let's get some more insights into what's happening in the Egyptian country as a whole. CCTV's Yasser Hakim is standing by in the capital, Cairo. Yasser, what are the latest developments with regard to the protests and some of the violence that has been linked to them so far?
Yes, the violence has started early. It was supposed to be on the 30th of June, the demonstrations, but already we have today another fatality. One man is dead and around 145 presumed injured, mainly in Alexandria, not in Cairo. Alexandria is the place where most of the skirmishes and battles are going on. And Cairo, the demonstrators, whether for or against President Morsi, are far away from each other, like an hour away from each other by road. So there's no room for clashes in Cairo, but mainly in other cities like Alexandria.
Indeed, we know the last time there were protests in Egypt, sometime around December last year, the central bank spent about $2 billion defending the currency. By end May, it had $16 billion in reserve. How much of that is cash they can actually use to defend the currency if they really have to this time around?
It's just the same. If you just make a breakdown of the amount, $3 billion are in gold. You've got around $6 billion from Qatar. You've got $2 billion from Saudi Arabia, $2 billion from Libya, which you can use because that's a grant, not a loan. The others are loans, and $1 billion from the military. So you've got around $3 billion, $2 to $3 billion owned by Egypt, not loans from anyone or gold reserves, which the central bank can play with in the next few weeks, days or weeks if the demonstrations are prolonged.
Has the spread between the official and the black market rate between the pound and the dollar been expanding in recent days, especially as we approach the 30th of June?
Yes, according to the CBE, the central bank rules, an individual can withdraw around or buy around $10,000 per day. Any business has $50,000 limit per day, but in actual practice, it doesn't happen. You go to the bank or you go to any institute and you cannot get the money you want, so you have to go to the black market, especially the businesses for import and so forth, and that brings more power to the black market and increases the gap between the real price and the black market price. And this is increasing in during this week because of the problems concerning the demonstrations. Maybe banks will not work. They said they will be open on Sunday, but maybe this will not happen if violence increases on Sunday or Monday. So we'll see about that.
Indeed. The army, of course, and the Al-Azhar Institute have also urged both sides to work out the differences peacefully. The army, of course, backing that up with a veiled threat, if you will, of intervention if necessary. But to what extent, really, does President Mohamed Morsi and the opposition really have control over their respective supporters?
Well, they both maybe more towards President Mohamed Morsi. He can control his supporters much more because the Muslim Brotherhood have always been known as a strict, very well organized institute, and their members depend on loyalty and every dealing, just like the army. And this can be said about President Morsi, but on the other side, the opposition, they have no way to control their supporters because their supporters are already divided between the radicals and the moderates, the ones who want peaceful demonstrations and the ones who see that the only way to oust the president is through violence. The leaders of even the rebel group that has been forming this demonstration are not part of the leadership of the Salvation Front or any leadership in the opposition. They are independent youth who have gone into this campaign that has garnered all the support and the mass demonstrations. So it's more unorganized with the opposition and organized and well disciplined concerning the president and his group.
Indeed. Thank you very much for that update. That's CCTV's Yasser Hakim live in the Egyptian capital, Cairo. We'll be keeping tabs on developments there, and of course, in the run-up to the protest set for the 30th of June, which of course, as he just mentioned, have started relatively early. Let's head to the other side of the continent now. Mining-dependent economies, especially South Africa, are fretting as gold is poised for its biggest annual loss in more than 3 decades after gaining in price for the last 12 years. Now, the price of spot gold having slipped below $1,200 a troy ounce, and many miners having declared that the operations in South Africa are essentially unviable below $1,500 an ounce, there's real cause for concern here. Now, the slide in price is mainly blamed on the US Federal Reserve cutting borrowing to a record low to bolster the economy. Investors around the world are selling their bullion from exchange-traded products at a record pace as unprecedented money printing by central banks right around the world has failed to spur inflation. Fed Chairman Ben Bernanke said this month that the American Central Bank, which buys $85 billion of Treasury and mortgage debt every month, may trim purchases this year and end the program in 2014 altogether if the United States economy does improve. Now, some analysts have described Barack Obama's African tour this week as an attempt to play catch-up, if you will. America's rivals, especially in the East, have been taking great strides to build trade relations on the continent. That said, though, the United States still remains a potent trade partner. CCTV's Sumitra Naidu explains why.
US President Barack Obama wants to strengthen trade ties, but he's got a bit of catching up to do. China's bilateral trade with Africa is worth more than $200 billion. That's almost double that of the US. But the US remains a strong trading partner, especially with South Africa.
The US is actually South Africa's number 2 biggest trading partner and has consistently been either our top first or our second trading partner for many years now. So it's an incredibly important relationship, second only to China. And this visit hopefully will be about strengthening those linkages and building greater interest from American companies in investing in South Africa and also trading with South Africa.
Even though China has increased its presence, trade between the US and South Africa has been on the up since 2008 when Obama took office. Foreign direct investment from the US now stands at over $6.5 billion.
He's been on record saying that Africa has the potential to be the next global economic success story. And his Africa trip, which includes South Africa, really is an example of how he believes South Africa is a key part to that vision. And what's really good for business here in South Africa from a trade perspective is the AGOA, the African Growth and Opportunity Act. And of course it expires in 2015.
The African Growth and Opportunity Act, signed in 2000, was designed to encourage free trade markets.
It gives us a great opportunity as South African business to highlight to President Obama while he's here the importance of the renewal of that act. In fact, about $10 billion of trade is done each year between South Africa and America, and about half of that is done through the AGOA. And it gives African businessmen the access, duty-free access to the largest market in the world. So we believe that it's really key for continued economic growth and continued entrepreneurial growth, which creates jobs, for the AGOA to be renewed.
Trade relations between the United States and South Africa have been overshadowed in recent years, with the attention moving to China and the other BRIC countries. Obama will no doubt use this visit to regain the initiative.
And there are hundreds of American companies who either have invested directly into South Africa or have joint partnerships or other ways of linking into this economy. So it's a very important economic partnership, and I think it has been a little bit understated in recent years.
President Obama will be accompanied by his economic team and several American business leaders. The U.S. says it views Africa as the new center for global growth. Sumitra Nadu, CCTV, Johannesburg.
Let's get some more data from the ground. CCTV's Angelo Coppola is live in Johannesburg tonight. He joins us now on the liner. Angelo, in looking at AGOA, seeking an extension/renewal, depending on which perspective you want to take on it, what specific changes would South African businessmen like to see to that law, and how will they pitch those changes to Barack Obama in South Africa?
Raman, it's quite an interesting question because it's Congress finally that's going to make a decision whether they're going to roll this thing over or they're going to renew it. So it doesn't matter how the president or his economic advisors in South Africa feel about it. We've heard that they are positively inclined to a rollover, which is probably the most easy to adopt kind of approach, where they won't have to make major law changes. So there's a period that they're talking about between 15 and 20 years for that rollover to be extended, or that continuation. The issue really is that the president has to now go back to Congress and pitch what we're pitching to him. So it's we're kind of relying on the president to buy into our idea and then take it back to Congress and get them to buy into the concept. So it's kind of a wait and see approach. We do know that the Obama administration officials are positively inclined, but essentially it's up to the president to now go and sell the AGOA story to Congress.
Indeed. Let's talk about domestic issues in South Africa. The Deputy President, Kgalema Motlanthe, has been working to broker an agreement of sorts between unions and mining companies on one hand. What's the latest developments on those talks?
Well, Raman, as you recall, the first round of talks broke down. They were meant to have a press conference where they were going to make this big noise about the fact that they've signed this guideline agreement that will kind of stabilize the sector. What happened was that the three players, the mines, the unions and government, walked away to go and consult with their constituents. It now, we're hearing, appears that there's some form of agreement or understanding about to be announced in the next couple of weeks. We don't have any detail, but we do know that something is imminent. So it's good news because, as you know, UMCU earlier this week put down their wage demands on the table, around 100% they were looking for. Obviously, it's a bargaining start. So the sooner that this groundwork or this guideline is put in place, the more stability we can see in the sector. Rama?
Indeed. We'll have to leave it there for the time being. Thank you very much for your time. That's CCTV's Angelo Coppola in South Africa. On the day, the weakness of the rand saw that fuel prices over there, retail fuel prices, we should point out, go all the way up to record highs. Time for a short break here on BizAfrica. Here's what's coming up next. We'll be in Maputo when we return, where a two-day regional investment conference has ended with hopes to mobilize some $64 billion for spending on infrastructure. The details when we return.
Talking tough on trade, conflicts over currency, and connecting economies around the world. From Tokyo to Shanghai and Mumbai, BizAsia links you live to the markets and brings you all the latest in business from China's unique perspective. BizAsia, a smart investment for your time.
Welcome back. Now, you may recall the trip to Mozambique, which the South African President Jacob Zuma cancelled due to Madiba's ailing health. Well, that conference is still proceeding as planned. The South African Development Community, better known as SADC, had its leaders meeting in the Mozambican capital of Maputo for a two-day infrastructure investment conference. The idea at that conference was to lure potential investors into rolling out the Regional Infrastructure Development Master Plan for Vision 2027. Now, essentially, that's a blueprint for a 15-year plan that will guide the implementation of a cross-border infrastructure project between 2013 and 2027. CCTV correspondent Julie Shire is in Maputo. She filed this report.
Under the theme Accelerating Infrastructure Investment through Sustainable and Innovative Financing, SADC representatives continued with the agenda despite South African President Jacob Zuma cancelling last minute due to former President Nelson Mandela's critical condition. The key objective of this meeting was for SADC to present the Regional Infrastructure Development Master Plan, in particular the short-term action plan, to potential investors, funders of infrastructure, and key international cooperating partners. But with these plans comes challenges.
The cross-border nature of these projects, you need several authorities to have a buy-in into the projects, and also project preparation. You know, the funds to do that is another key area that must be addressed, as well as, you know, the capacity, you know, the technical wherewithal to undertake these projects. So those are the key challenges, but I think as a region now, I think we are geared towards addressing those.
The main focus was on energy and on how the private sector, together with financial institutions, can play a major role in improving access to modern energy services and tapping into the abundant energy resources in the continent. Particular attention was placed on Mozambique.
We are actively involved in supporting Mozambique to realize that potential. We are in the call. We are one of the potential funders in the call with Vale. We are into the gas, assisting Mozambique to do feasibility studies and quantify how much they have in terms of the gas. So yes, we are actively involved in supporting them to realize this potential and invest to make sure that it is actually realized.
Infrastructure is a very important key platform for development. Not only rails and ports, but also communications, airports and everything. We need, as investors and as mining company, we need to support all of this sector. But for sure, for us, the key one is rail and port.
Each one of us will play his role. Governments, private sector, ICPs, and regional bodies, COMESA, EAC, and SADC. Once we have that, and we provided the legal framework, I think that we can move. And it's better to invest now, because otherwise then we'll be too late.
The two-day Regional Infrastructure Investment Conference here in Maputo hopes to mobilize $64 billion over the period of 15 years. An ambitious master plan that leaves the question, can it be sustainable? Julie Shire, CCTV News in Maputo, Mozambique.
Now, the International Monetary Fund has warned that there are implementation risks facing Ghana's aim to cut its budget deficit to 6% of GDP within 3 years. The Ghanaian government outlined plans in March to trim the deficit by 2015 to that level after excessive election spending last year helped to push it to 12.1%. That's more or less double, really, the target of 6.7%. IMF says success in reaching the medium-term target depends on whether politically difficult measures like adjustments to energy prices to full cost recovery levels will be implemented in a timely and durable manner. Now, to allay investor concerns that the government recently announced that it would scrap costly subsidies on fuel, Ghana is preparing to issue a second Eurobond in July to raise up to $1 billion to restructure debts and finance infrastructure projects as well. Let's dig a little deeper into the IMF's Article 4 consultations with Ghana. CCTV's Miriam Bemard in London has been going through the data. She's live in London right about now. Miriam, can Ghana really cut government spending without at the same time hurting its growth prospects?
Well, you know, Rama, the government had outlined the plan back in March to cut the deficit, but we have to consider that Ghana's debt has been ballooning for some time. You know, since last year, actually, we've been seeing the public sector wage bill just mounting. And of course, that combined with energy subsidies pushed up the deficit to 12%. That led to the public debt ratio deteriorating, of course. At the same time, growth prospects are under pressure after the Bank of Ghana tightened monetary policy to stop the rapid depreciation of the cedi, but we're now seeing that the real interest rates are soaring as well, and that's sort of coming into play. The government is trying to sustain growth by, you know, boosting things like oil production to keep GDP growth at about 8% and try to offset the gap. But the expectation is that all other sectors will likely slow down this year, and this will certainly pose a challenge for Ghana.
Now, from the fund's perspective, when they talk about these implementation risks, what kind of roadblocks are they seeing exactly? Because we did see Ghana raising fuel prices the other day, sometime earlier this year, to no protest at all.
Absolutely. You know, inflation is one of the big problems. The report warns that it's expected to go above 10%. But it's also clear that oil, like I had mentioned before, will not be able to create enough growth to reduce some of the roadblocks and, you know, close the deficit gap that we're going to see. And one thing that is draining the government's purse is the fuel subsidies that you were just talking about. Although it has announced that it would scrap the subsidies, but the government will still have to deal with ongoing, you know, energy disruptions and high real interest rates. And these aren't issues that are expected to go away anytime soon. So on the flip side, experts are warning that exports for things like cocoa and gold, two key sectors for Ghana, is also expected to slow down.
Indeed. Finally, one interesting trend that we also noticed from Ghana's macro data, non-oil GDP growth has been slowing down since 2011. Now, is that a warning signal to investors on your end of the pond, especially, that perhaps Ghana started to focus on oil at the expense of everything else?
Well, actually, I wasn't too sure about this, but after talking to quite a few experts, investors are actually still quite keen on Ghana. And analysts say the country's top investment officials have actually been meeting with private sector businesses in banking and mining and tourism and other sectors. And this is all part of Ghana's government initiative to create stronger bilateral ties. In fact, analysts are saying that the government's program includes a very competitive tax rate at a maximum of 25%. You know, Rama, when you compare it to like South Africa, which is 40%, investment guarantees and custom duty exemptions on imported industrial plants and all sorts of incentives like tax credits for small businesses. And certainly this is still making Ghana incredibly attractive.
Indeed. We'll have to leave it there for the time being, though. Thank you very much for your insights. That's CCTV's Miriam Bemard live in London. Now, of course, keep in mind that Ghana also happens to have one of the best performing stock markets in the African continent, up about 60 or so percentage points so far this year. Let's see what the other contemporaries on the continent are doing with your money so far, at least by the end of the week. The Nigerian all-share, for instance, down in the red by about 0.8. The all-share index in South Africa in the green by just over 0.3. The 20-share index in Nairobi very, very much on the rebound, especially as far as today's concerned. Expect the next wave of results coming in from July onwards to boost its numbers further, up about 1/3 or so. In the Egyptian market, of course, today being a Friday, was closed. That's business for you this week from Africa. I'll be back on Monday with a lot more. Right now, back to Penina for the sport.
Thank you, Ram, and see you Monday.